In 1994, I guess because of the war, they didn't do it at seaside, free from the U-boats or the German submarines. They did it in a ski resort, but in 1976 they didn't have that problem. One other thing Jamaica was famous for those days, and it still is. We call it Mary Jane. And they got together and said, okay, we're going to have some rules. Now, we're going to allow flexible exchange rate regimes. And they still kept things like IMF programs to help out countries with acute external deficit issues. But they didn't have any problem after that. And central banks could intervene if there's too much short-term volatility, which means too much movement up and down. They officially abandoned gold as an international reserve asset, and countries, especially less developed countries, they had more access to IMF funds. If you look at the graph of US dollar, this is kind of a trade-weighted value. So the currencies that have a higher percentage of trade with US have higher weight. Here, higher values mean higher value for dollars, lower values mean lower. So US dollar was kind of going up. When the Bretton Woods collapsed, it lost close to 20% of its value. But starting late 70s, especially after the oil shock, kept climbing. This is 1986. Those days, for example, $1 US bought about 300 yen. And Japanese were completely happy about that because their automotive industry had developed in 60s, but in 70s it came into its own in terms of quality as well. They weren't just cheap, they were also better. So they started selling a lot of stuff to US. As long as yen was weak, they had no problem. And they had an agreement that said, okay, we're gonna intervene in foreign currency markets and we're gonna reduce the value of dollar. And by late 80s, dollar was trading at 80 yen instead of 300. And it went up again during the tech boom, during the 2008 crisis. It kind of hit almost historical lows, and we're about here these days. After COVID, US actually gained quite a bit in value, US dollars. So there's a lot of variation now. You can also see from Fred, for example, US dollar, Japanese yen, spot exchange rate. Let's see, this is daily. Let's do other frequencies. Let's do quarterly. Yeah, it's available since 1960. Early 60s, $1 bought 360 yen. By 95, it was down to 84. This collapse, look at it here. This is right before Plaza Agreement. $1 bought about 257 yen. By middle of 95, it was 84. In addition to real estate issues in Japan, That was one of the major reasons Japanese economy collapsed in 1990s. The Japanese call 1990s the lost decade. They did not have a single year of positive GDP growth. Let me put it that way. I mean, there were two drivers of that. As you very well know, Japan is an island country. There are 4 major islands, but most of the islands, they're probably of volcanic origin. They're mountainous. Okay? So the percent of actual land that is available for agriculture and settlements is very small. The Japanese population is over 100 million. Okay? Land-wise, Japan is probably 1/4 of the land of Turkey. Turkey has a population of 80 million. Or it's 1/3 of France. France has a population close to 65 million. Probably similar to England, maybe 1/2. England has a population of 80 plus million. But England doesn't have that much mountains except in Scotland. And nobody lives in Scotland, in the highlands. Lowlands, they do. Right? All the whiskey country, you don't have many people. But lowlands, you have all the people. That means, as the Japanese were making money in the international markets through their external surplus, all that money had to go somewhere. So a lot of corporations actually bought real estate, and revaluations of those real estate increased the value of the firms. As they increased the values of the firms, they kept buying more real estate. So there was a big real estate bubble. That collapsed in 1989. Back in 1989, the value of the major Japanese stock index, the Nikkei 225, was close to 30,000. I'm sorry, 40,000. This is in Japanese yen terms. By 95, it was 8,000. That is a 80% decline in yen terms. Now think of the same thing in dollar terms. The currency itself gained value. So in dollar terms, divided 8,000 by another 3. So it would have been roughly, 2,600, 2,700. So in dollar terms, Japanese stock market lost 90% of their value. I'm not talking about an individual stock. These are the 225 largest stocks in Japan. It includes companies like Honda, Toyota, Mitsubishi, Bank of Tokyo Mitsubishi, other banks, and stuff like that. Sony, which dominated the TV market in the 80s, for example. They don't do it anymore because you have so much competition from other countries. But in the 1980s, if you had a Sony TV, you were good. They cost 3-4 times as much as a TV made in America, for example, Panasonic. Of course, they collapsed. So exchange rates are important in driving the fate of a country. Let's talk a little bit about current arrangements. Certain countries have said, okay, we're not going to have our own currency. Just like Georgia has the same currency as Kentucky, right? In both Georgia and Kentucky, you can use the US dollars that is printed by the Fed and the coins minted by the Treasury. They're both legal tender. Well, the same thing is true for countries like El Salvador, Ecuador, Panama. They don't have their own currencies. There is no Ecuadorian peso anymore. They used to, but they don't have it anymore. You just take your US dollars there, it's valid currency. In most less developed countries, that is true independent of whether there is a separate legal tender. Trust me, if you have only US dollars in your pocket and you go to Vietnam, you're good. They're gonna take your US dollars and they will give you change in US dollars if you want to. If you want your change in dongs, you will get it in dongs. I mean, I spent some time because of a layoff in airport in Iceland. You know, I gave them cash US dollars. They gave me my change in Icelandic kroner. But I wanted some of their coins and banknotes so that I could keep them later. But I could have also gotten my change in US dollars. But you can't simply take, let's say, Chinese renminbi, take it to Iceland. They're going to say, no mas. It's not going to happen. Use your credit card. Or even if they take it, they're going to apply such a horrible exchange rate to it with offer spread. You're better off using your credit card. So for these guys, they have no issues. There is no exchange rate between US dollar and anything. They do most of their trade with US anyways, given that they're so close to them. Certain countries have regimes called currency board. These are fixed exchange rate regimes, and the currency is actually fully backed by either US dollar or some other reserve currency. It is similar to gold standard, but instead of gold to back up the currency, you have the reserve currencies. So in a sense, US dollar is the gold.